Gave up managing billions to become a better investor. Episode 39. Will global markets make money in Q4 2023? Hello. Yes, it's the 1st of October as I speak. Therefore, it's the first day of the fourth quarter of the year. Final quarter of the year. Exciting. What's been going on and where are we going? Even more importantly, as always, what's gone has gone. Far more important to know where we're going or where we may be going over the next few years, months, days, and related. So I guess you could say that the Q3 numbers were a little bit volatile in many global markets. If you look year to date, we've still got most global markets, particularly if you look outside of small caps and certain other individual markets such as China, for example. Most equity markets are actually up, certainly in the large caps focus, and especially if you had orientation towards the technology sector and related, has been fantastic for headline numbers in the States, in Japan, parts of Europe, etc. Although, of course, you've got to acknowledge choice of individual investments has been very important. It's very, very focused, some of those returns, on particular areas. And if you didn't have exposure to them, then you struggled a bit. But we've talked about this before. As you know, I think kind of the technology space is probably a little bit in some areas over-purchased at the moment, and I think opportunities lay elsewhere. But that's for another time. I've talked about it too many times probably already. Let's focus again on what's happened so far year to date, and specifically in Q3. I guess that bonds have remained mixed at best. I mean, it's kind of interesting. When I look year to date, certain high yield bond areas have been positive. And obviously we're talking total returns here. And clearly high yield has one advantage in terms of the amount of natural yield it would give you, assuming that obviously the stock remains relevant and payable and related. Elsewhere, though, many government bond areas have struggled a bit. It depends a little bit what currency you're in. Obviously, the dollar has gone up, which has been kind of interesting. So that's been remunerative for some areas. For example, I was looking in sterling terms, and certain areas have performed all right in sterling terms, but less well in local currency terms. But generally, bonds have continued to struggle on domestic FX sort of basis. And we all know the reasons why. Essentially, concerns that interest rates will remain higher for longer as we look sort of later into the 2020s. Still some concerns about inflation. I think that's correctly abating at the moment. I think it's more to do with the fact that we're not moving back quickly into this lower interest rate setup, which many people thought in the 2010s was the normality. And reality is it isn't, because let's face it, we all know what reality is. If we've been around markets for more than 15 years or so, we know that the 2010s was an aberration, as I've said before, and the 2020s will be much more akin in terms of some of the natural volatility we've seen in pretty much any other decade, i.e. Today's interest rates are not particularly unusual. What it means is that valuation of certain areas are not going to be as wonderfully brilliant. Not everything's going to perform for you. You've got to pick and choose carefully, work hard, and related. We all know that, and you've heard me talk about that too many times already, undoubtedly on these podcasts. But that still seems very relevant, very pertinent, not just for the Q3 performances that have just occurred or the year-to-date ones, but also prospectively too. Frankly, the world isn't changing rapidly and quickly. It's not going to be, oh my goodness, things are suddenly going to get much, much worse or much, much better. You just have to, I don't want to really use the phrase, but I was going to say grind it out, which means kind of you've just got to keep on working hard to try to get some positive results from your portfolio. And that's how it should be. If investment management was easy, number one, everybody would be doing it, and number two, everyone would be, I guess, theoretically on the beach. But it kind of doesn't work that way, does it? You've got to be correctly a medium-term investor, and you've also got to be sensibly invested, and you've got to be sensibly allocated for your wider, broader personal life requirements and aims and objectives and family matters and related issues. So, interesting markets. What is happening prospectively in the world? We could talk about events that have occurred over the last 3 months or year to date or over the last year or two. We talked about most of those probably already. Prospectively, let's think geopolitics first. Clearly, the world remains uncertain. We're still, unfortunately, always and will have some semblance of deep, more than just political uncertainty in various geographies around the world. That's just the way things are. Do I think that the risk of aggressive, overt trade wars, overt actual wars occurring? Am I very, very concerned about that backdrop? The answer is I'm not. And I say that for a few reasons you've heard me talk about before, which is that I think actually the costs of such actions are becoming higher and higher. And it's kind of interesting, isn't it? As we see populations aging, and it's not just that people are becoming wealthier and therefore there's more to lose from even a government taking, a political leader taking actions. And we've seen that, as we saw just over a year ago here in the UK, in terms of some of the volatility of how volatility in the bond markets can impact matters politically and ultimately impact changes in who is the prime minister or is not, or at least certainly influence that backdrop. I think most governments, I'm not going to say all governments, most governments have a deeper understanding of that now. Now, I guess what's kind of interesting politically, we're going to get some great insights, frankly, in 2024, and there's a bunch of rather important elections occurring. And we'll see whether political choices are going to be centred on what is attractive at that moment in time, or what is possibly a bit more sensible for the medium term. In a world where the population is aging and matters such as taxation, for example, are going to become more discussed. Because let's face it, the flip side of an aging population, even of more wealth at a personal level per se, it also means, in most cases, more government debt. It's kind of an interesting backdrop. And certainly when we come back to financial markets, bonds remain, you've got to get back out of that 2010s mentality and more into sort of the interaction of bonds with underlying interest rates, debt realities, and obviously some acknowledgement of what inflation is or is not likely to be. But my thoughts are, as I've said before, if you want to make money on a total return basis for your pension fund over the medium term, and the medium term I'll be defining as in excess of 18 months. 18 months to, let's call it 10 years. I think to look any longer than that is going to be always difficult. But let's call it something that's smart for a pension fund, i.e. for some decade, further on in your personal life profile. I still think it makes more sense to be equity rather than bond centered. And I know many portfolios are not that oriented. I've talked before about actuaries and, oh my goodness, what on earth are they up to? But I know that's prudent. And unless governments start defaulting and related, I can understand that. However, from a purely what I would regard as sensible investment allocation, something which as an investor makes more sense to me, my thoughts. I would still much rather be, as a still just about sub 50-year-old, I still much rather be circa 90% invested in equities, bunch of allocations, different sectors, personal choices and related, and circa 10% in gold and gold facing, and have nothing in bonds. And as you know, I've taken the view that that bond allocation is, to me, a more sensible bond allocation is your age minus 50. And so if you're 65, your bond allocation is 15%. If you're 85, your bond allocation, if my maths is correct, is 35%, etc., etc. And I know that seems radical compared to how many portfolios are allocated to, let's call it the 50 plus age group in society when you look at what actuaries are looking at mathematically. But it fails to understand the point that the world is shifting and evolving. Aging populations are impacting how you should prudently be invested in and related. But anyway, you've heard me talk about that too many times. To bring it back to 2023, I find it fascinating with all these issues going on, geopolitical matters, slow shifts with politics, with population profiles, debt aging, naturally, correctly, commodity and environmental matters, over the medium term, etc. Many issues to be thinking about. I would still say that the markets, or at least the fear and greed index, which, as you know, I'm a big fan of, and I'd always highly recommend people looking at it, because you've got to be, as the saying goes, you've got to be fearful when others are greedy and greedy when others are fearful. And I found it fascinating that a few days ago, we briefly saw in the fear and greed index a period of extreme fear. Now, as we talk over the weekend, it's in the sort of the more normal general fear area. And so that brief flirt with extreme fear kind of told me that, hang on, opportunities are building again to find or add to interesting investments. It's kind of interesting. I was looking at my own personal portfolio over the weekend, and I was starting to find, that's interesting. 2 or 3 of my holdings were now flagging at levels which was thinking, well, maybe it's smart to add a few more. And of course, as we're coming up to the quarterly earnings season in a couple of weeks' time and beyond into November, it's a timely, opportunity to start thinking about, how am I going to respond to the corporate earnings season? I'm excited, as always, about the corporate earnings season. To me, that's the most interesting aspect of all possible investment sources. I know, as I've talked about before, you should be spending circa 25% of your time on geopolitical matters, and you should be spending circa what I would call 75% of your time on corporate sector, and let's call it analytical methods relevant to your choices of a particular type, style, area of investment. But that 25% split in time split in geopolitical matters and top-down views, it's always important. It's always insightful and interesting. And I find it insightful that we have had this sort of brief extreme fear backdrop. And I can understand the reasons why. We've talked already on this podcast about, are people thinking about, are interest rates going to remain higher for longer? What does that mean for my personal life, stock market valuation, bond yields, and hence everything by definition? And I think, though, that the reality of the world in most countries is probably a little bit better than people think. I know that I've talked already that if you look at losers year to date, that would bring you to areas such as China from a sort of a geography basis or market basis, and also areas such as the bond markets, small caps generally, and related. On China specifically, I find I can think of reasons why people are concerned. We can see plenty of geopolitical, trade, and related discussions ongoing. However, we fortunately are still seeing discussions ongoing. I think that's a far more important insight. And my view would be that Xi Jinping, sadly, don't get the opportunity to talk to personally, but if I was talking to him personally, I think if he was willing to share some deep thoughts with me, my feeling would be that he realizes that, I know he wants his agenda. He probably knows it's on, well, I would have thought he's on his last term as president of the People's Republic of China. My guess would be he's got to play a smart game here too. Otherwise, you don't want to be sort of leaving your time in charge in embarrassment, something which perhaps Mr. Putin in Russia can give him a little bit of advice about. Because I think often people sometimes, in many ways, go on for too long. Perhaps this podcast is going on for too long already on that basis. But my observation would be is that smart people jump out when the crowd are asking for more, or you exit stage left quietly at that point. And politicians, what's that rule about politics, that every political career ends in a disaster, in a failure? And it's sort of funny that is worryingly true. And my feeling is China's not in a terrible position. I know there's a lot of angst about the property market at the moment, as well as geopolitical issues and related, but I still see great scope for value and sort of not just profit, but also wealth growth in the country over the next, let's call it the next 20 years. As I said, when I look at China today, reminds me of my own growing up in the UK in the 1990s. That's what it reminds me of. And that sort of means that the 2020s and 2010s equivalent, which is, I guess, the next 20 odd years, is kind of more than workable. But ultimately, you do have still aging population issues and building debt issues and related. And we haven't even talked about at length matters around issues concerning the environment and related matters. But what I would say is that angst over, oh my goodness, we've got an immense geopolitical challenge, and that's going to just really hurt the global economy backdrop is, I think, a little bit overdone. I don't think we're moving into a trade war. I know that I've seen certain US politicians, not currently elected ones, talking about issues which would be consistent with isolationism or something along those lines, something we certainly touched towards that. And I kind of don't think we're going there either. I think lessons from frankly the 1930s are more than enough you need in order to know what not to do for the, let's face it, not even the 2030s, the rest of the 2020s. Tell you what I'm going to be interested in terms of upcoming events. Number one would be whether Xi Jinping and the US president, Mr. Biden, will actually physically meet. And there is a good chance, I think, in November that they will. I think that would be a good thing, even if nothing is particularly overly aggressively agreed upon. I think that would show a little bit of hope for 2024. Corporate earnings season is going to be fascinating as always, and I think that's the kind of what I would regard as the normal backdrop. It's a workable backdrop. Some good, some bad, some horrible, some brilliant, some perfectly average. That is the way the world is. Frankly, this notion 2010s Mark II, oh my goodness, everything is great, everything is awesome. It's erroneous. It's not the reality of the world. I'm fascinated to see what happens in the UAE with the COP. Let's get me the number right. COP 28. You said 29 conference. COP 28 in I think it starts in late November. I mean, environmental matters are. I know some people don't find them uninteresting. They're not. They're super important. The fact that the conference is being hosted in the UAE is an interesting choice at many levels, and I'm going to be fascinated to see what is discussed there and what is some of the tentative conclusions that occur from there. So interesting times. It's not boring out there. Central banks, you know my thoughts on that already. I think we've already had an indication that the world's largest central banks are slowing down their rate rising scheduling. Some, as you know, my personal thought would be that they should not raise them any further. But hey, ECB did it last month. Let's see what happens over the next few months. My prudent thought would be don't raise rates any further. I don't think there's the requirement, but we shall see on that. But when I look at that backdrop, I see equity and bond opportunities. I see general investment return scope for the rest of 2023. So in answer to my simple question, I would remain long assets for the rest of 2023. My personal allocation, for full disclosure, is still circa 90% equities, circa just shy of 10% in gold, and the remainder, 0 to 2%, probably nearer to 0 to 1% allocation is in cash. So I've got a little bit of dry powder, not very much, and that will no doubt be put to work in the corporate earnings season or after results. As always with the corporate earnings season, you don't make decisions just before a company is going to give an update, a new quarterly view. You do it slightly afterwards, whilst listening to the conference call or related. Believe me, for everyone that you miss upon, there'll be 5 or 10 that you'll find an opportunity with. Believe me, that's always the way. But much to think about re 2024 already. I'm already feeling excited about putting together a podcast in late December about thoughts towards 2024 and hopes and fears and related for that period. But we shall see on that front. I'll finish though with one quote I thought was very relevant, and it was from somebody far smarter than me, far better well known than me. My goodness, and the quote is, "Never spend your money before you have earned it. And that is so true. My goodness, that was Thomas Jefferson, by the way, in case you don't know the quote. And told you he was much better known than me and famous correctly at many levels. And it's interesting. We've got a global housing market which is becoming a bit more mixed, to say the least. And people are worried about that personally. And I understand it. But a home is somewhere to live in, not somewhere to have as an investment. Yeah, sure, nice if you've bought a house or your parents have bought a house and then wonderfully, 2-3 generations later, it's worth an awful lot more than they paid for it. Fantastic. But you've got to live somewhere. We should buy somewhere to live, or at least try to buy somewhere to live. The good thing about the housing market, I think, actually said it's going to be easier for newer investors, people thinking about buying a home over the next, let's call it 10, 15 years. I think there's going to be a bit like bonds, really. People's perception of housing as being a fantastic forward investment is going to also shift over the next 10, 15 years. Again, it brings us back to the notion that the better area, the better style for people to invest it into remains, from an allocation perspective, carefully chosen equities. And we can talk again about different geographies, different sector perspectives, different individual companies and related. Bit of gold and gold-related assets. I know some people say crypto, but yeah, one for the experts from my perspective. Not too much cash, pay your bills, but for your portfolio, for the money that you're saving for the medium term, your retirement, whatever other your medium term aims are. I think cash, once you've made the decision to allocate money into the area, you don't want to be pulling your money out because you'll be doing that at the worst times. That's so easy to do in the investment cycle. Pay your bills, and then with your money left over, invest money. Absolutely. That's always the smart way to be set up on these matters. But overall, I think it remains workable out there. And maybe I'm a glass half full sort of guy, but my view would be life remains all right. I'm remaining optimistic about Q4 2023. We shall see, I guess, in circa 3 months' time whether that's correct or not. But anyway, I'll embarrass myself on both perspectives on this podcast in late December, in any case, to see whether I've been roughly correct or roughly incorrect, or a bit of both, as I guess is the norm. We shall see. Thanks very much for listening. Hopefully some of that was interesting, and I'll speak to you soon. Bye-bye.